Having talked about T accounts and general journals, let me now share about common accounts and their respective balances. From an entity's point of view, dividends are a form of expenses, and as they are paid out of their earnings. And since earnings and revenue have credit balances, dividends have debit balances and goes into the income statement. Prepaid expenses behave like an asset because these are expenses that we pay in advance. An example would be rent. Thus, this implies that we are entitled to ownership of said expense. Like all assets, prepaid expenses also have debit balances and is classified as current expenses in the balance sheet. Accrued expenses, on the other hand, behaves like a liability because these are expenses that the firm has incurred but has yet to pay for. An example would be utility bills. Like all liabilities, accrued expenses have credit balances and is classified as current liabilities in the balance sheet. Unearned revenue, as the name suggests, behaves like a liability because it refers to revenue transactions where the entity has received payment in advance for goods and services they have yet to provide. Accrued revenue, on the other hand, behaves like an asset. It refers to revenue transactions where the entity has delivered goods or services but have yet to receive payment. Hence, it has a debit balance like all assets. Lastly, depreciation expense is the periodic non-cash devaluation of a firm's non-current asset. Hence, like all other expenses, it has a debit balance and goes into the income statement. The concept of cash accrual versus cash accounting. Accrual accounting is when transactions are recorded when they occur regardless of cash flows. On the other hand, cash accounting is when transactions are recorded only when cash flows. Accrual accounting is the recommended method as entities want to recognize revenue when we earn them and not when money is received. This is because it is very common actually for payment to be delayed after goods or services have been provided, depending on the payment terms. This means that cash accounting will not be the most accurate representation of a given period's net income, since a good chunk of this period's payment will only be received in the following period.